All right, let's talk about a powerful tax strategy that honestly most real estate investors have never even heard of. If you own rental property, this could literally put tens of thousands of dollars back in your pocket, sometimes in the very first year. It's called cost segregation, and it's a game changer.
So are you. The honest answer is, yeah, you probably are. So many investors do, and they don't even realize it. They're just following the default settings the IRS gives everybody. And this number you're looking at, that's not just some random figure. That's the kind of tax savings you could potentially see in the first year alone on a pretty typical $500,000 property. And over the next few minutes, we're going to show you exactly how that works. So how in the world do we get to a number that big? Well, it all starts with understanding the absolute foundation of real estate tax benefits, and that's a concept called depreciation. Okay, this is so important to get. The IRS knows your building isn't going to last forever. It gets older, things wear out. So they let you write off a piece of its value every single year. It's a loss on paper, a paper loss, but it creates very real savings on your tax bill, even though you're not actually spending any cash. But here's the kicker. The standard default IRS schedule is, well, it's incredibly slow. For a residential rental, you have to stretch that deduction out over 27.5 years. And for commercial, a staggering 39 years? That is a long time to wait to get your tax benefits. But what if you didn't have to wait that long? What if you could hit the fast forward button on those deductions? That, my friends, is exactly what cost segregation does. It's the accelerator. So, what is a cost segregation study? At its core, it's a detailed engineering analysis that basically takes your building apart on paper. Instead of treating it as one giant lump depreciating over decades, it identifies all the pieces that wear out faster and pulls those deductions way, way forward. So what are we talking about here? Well, think about all the stuff that isn't the actual structure of the building. Things like the carpet, the kitchen appliances, all the light fixtures. That stuff can be moved into a much faster 5-year schedule. And then you've got your exterior stuff like the parking lot, landscaping, fences. Those can go on a 15-year schedule. Now, this is where we pour a little rocket fuel on the fire. Once you've identified all those faster depreciating items, you can use a special rule called bonus depreciation. This lets you take a massive chunk, sometimes even 100% depending on the tax law for that year, of the deduction for those items all in year one. No more waiting 5 or 15 years. You get it right now. And this chart, wow, this really tells the whole story. Let's use that 100% bonus just to see the sheer power of this. On a typical $500,000 property, a study might find 120 grand of these reclassified assets. With the standard method, your first year deduction is tiny. But with cost segregation and that bonus, you could potentially deduct the entire $120,000 in year one. It's not even close.
And that, right there, brings us full circle to that big number from the beginning. If you're in, say, a 37% tax bracket, a $120,000 deduction translates directly to about $44,400 in actual tax savings. That's real cash that stays in your bank account instead of going to the IRS.
Okay, so you've saved a ton of money up front. Awesome. But we got to talk about the long game. What happens years from now when you sell the property? Or what if you want to pass it on to your family? This is where planning is absolutely critical.
Of course, there's always a catch, right? And this one is called depreciation recapture. It's basically the IRS's way of saying, hey, that's great you took all those tax deductions, but now that you're selling for a profit, we want to tax a portion of that benefit back. But here's the thing. It's not a reason to avoid this strategy. It's just a reason to plan your exit from day one.
And you've got to understand this part. The recapture on the main building structure itself is taxed at a max of 25%. But all those components you reclassified, the carpet, the appliances, all that stuff, that gets recaptured at your ordinary income tax rate, which could be as high as 37%. The upfront savings almost always make it worth it, but it's something you have to factor in. But what if you could legally sidestep recapture altogether? Well, for building generational wealth, this is the secret weapon. It's called a stepped-up basis. If you pass away and leave your property to your heirs, the value of that property essentially hits a reset button. It steps up to whatever it's worth on the day you die, and poof, all that depreciation you took over the years is completely wiped out. Zero recapture tax for your family. Now, this is so important, so listen up. How you own the property matters immensely. If it's in a simple revocable trust, you're golden. It gets that stepped-up basis. But if you've put it in certain types of irrevocable trusts, the IRS recently made it very clear that, nope, the step-up doesn't apply. Your heirs could be on the hook for all that recapture. I mean, this one little detail could be a six-figure mistake.
And hey, if you're sitting there kicking yourself right now thinking, oh man, I've owned my rental for 5 years, I missed the boat, I've got great news for you. It's not too late. You can do what's called a look-back study. It lets you capture all that accelerated depreciation you missed out on in one giant catch-up deduction this year. And the best part? You don't even have to amend your old tax returns.
So let's bring all this home. What does this really mean for you and your portfolio? Why does this even matter?
It really boils down to three huge wins. First, you get immediate cash flow from a much lower tax bill. Second, you can use these massive paper losses to shelter your very real rental profits from taxes. And third, and maybe most importantly, you accelerate your wealth building. Cost segregation doesn't change how much money your property makes, it changes how much of that money you actually get to keep and reinvest to grow your portfolio faster. So as you can see, this is way more than just some clever tax loophole. It's a fundamental financial strategy. If you own rental property, the next logical step is to figure out how these numbers could apply to your specific situation.
Look, at Apex Reserve Group, this is what we do all day, every day. We help investors just like you navigate this whole process. If you're even a little curious about what a cost segregation study could unlock for you, we offer a free, no-pressure analysis to start. You can learn more and book a time to talk on our website, apexreservegroup.com. Thanks for watching.